In 2001, Enron's annual report landed on the desks of Wall Street analysts looking healthy on the surface. Revenue was rising. Reported profits looked strong. The stock was one of the market's favorites. Less than a year later, the company had filed for bankruptcy. After the collapse, investigators, journalists, and market commentators pointed to disclosures within Enron's public filings, including information contained in the notes to the financial statements, as part of the broader picture that raised questions about the company's financial condition. Many investors, however, focus mainly on the headline numbers. The biggest lessons in an annual report often aren't on page 1. An annual report isn't just a corporate brochure. It's a legally required document explaining what happened to a company's business and finances over the previous year. Yet many retail investors never read beyond the opening pages. By the end of this video, you'll know how to understand the 4 sections that matter most: the income statement, balance sheet, the cash flow statement, the notes to the financial statements. This video is for general educational purposes only and isn't personalized finance. The income statement looks straightforward. Revenue, expenses, profit. But experienced investors often look beyond the final profit number and ask a different question. How good is the revenue? In the early 2000s, regulators investigated several companies for practices such as channel stuffing, shipping extra inventory to customers before quarter end to increase reported sales, even though some of those products were later returned. The lesson isn't that revenue is unreliable. It's that revenue should be evaluated alongside other financial information. One useful comparison is revenue versus accounts receivable. If accounts receivable grows much faster than revenue over time, it may indicate customers are taking longer to pay, or that the company is recognizing sales faster than cash is being collected. That doesn't automatically signal a problem. It's simply a question worth investigating. Next comes gross margin. Gross margin measures how much revenue remains after direct production costs. If revenue keeps growing while gross margins steadily shrink over several years, the business may be relying more heavily on discounts or facing higher production costs. Again, context matters. Finally, look for recurring one-time charges. Businesses occasionally experience unusual expenses, but if non-recurring costs appear every year, it's reasonable to ask whether they're really unusual at all. A company can report accounting profits and still face financial stress. That's why the balance sheet matters. It shows what a business owns and what it owes. One commonly used measure is the debt-to-equity ratio. This compares total liabilities with shareholders' equity. A rising ratio can indicate that growth is being financed increasingly through borrowing. That isn't necessarily negative. Some industries naturally operate with higher debt levels than others. Always compare companies within the same industry rather than using one universal benchmark. Next is goodwill. Goodwill arises when a company acquires another business for more than the fair value of its identifiable net assets. Large goodwill balances aren't automatically concerning. However, if management later records a goodwill impairment, it means the acquired business ultimately proved less valuable than previously expected. Many large public companies have reported significant goodwill impairments over the years. It's worth understanding why. Another useful measure is the current ratio. Current assets divided by current liability. It offers a snapshot of short-term liquidity. A ratio below 1 isn't automatically a crisis. Some healthy businesses regularly operate that way. What's more informative is whether the ratio is improving or deteriorating over time. Finally, notice treasury stock. Share repurchases are legal and common. They can increase earnings per share by reducing the number of shares outstanding. But if buybacks are financed primarily through increasing debt rather than business performance, that's another trend worth understanding. Many analysts place significant weight on cash flow because it can be less affected by certain accounting judgments than reported earnings. The cash flow statement has 3 sections: operating activities, investing activities, financing activities. Operating cash flow measures cash generated from the company's core operations. Investing cash flow reflects purchases and sales of long-term assets. Financing cash flow records borrowing, debt repayments, dividends, share issuances, and buybacks. One useful comparison is net income versus operating cash flow. If reported profits consistently increase while operating cash flow remains weak or negative, it may suggest earnings aren't translating into cash collection. That doesn't automatically indicate wrongdoing. Growing businesses sometimes experience temporary timing differences. The important part is whether the gap persists over multiple years. Another widely followed measure is free cash flow. Operating cash flow minus capital expenditures. It estimates how much cash remains after maintaining and expanding the business. Many long-term investors consider free cash flow an important indicator of financial flexibility. Still, no single financial metric should be viewed in isolation. Finally, examine financing activities. If dividends or share buybacks are being funded primarily through new borrowing rather than operating cash flow over an extended period, that's another long-term trend worth evaluating. Here's a practical checklist. Don't begin with the press release. Start with the financial statements. Compare revenue growth with accounts receivable growth. Track gross margins across at least 3 to 5 years. Compare debt levels with similar companies in the same industry. Compare net income with operating cash flow. Then read the notes to the financial statements. Companies are required to disclose accounting policy changes, major assumptions, related party transactions, litigation, commitments, contingencies, and other material information. These disclosures often provide important context that headline financial numbers alone cannot. Here's the takeaway. The income statement tells you how the company performed. The balance sheet tells you what it owns and what it owes. The cash flow statement shows how cash actually moved through the business. And the notes to the financial statements provide critical context that helps explain the numbers. You don't need a finance degree to begin reading annual reports. You simply need to know where to look. If you found this helpful, follow the channel. Next, we'll break down how stock prices are actually formed in the market and why the price you see on your screen isn't quite as simple as it looks.